we talked on that first slide, which was how do we avoid the capital gains tax altogether? So in this case, we have Mr. and Mrs. Real Estate. They have a duplex valued at $1 million. They bought it for $350,000. They fully depreciated it down to $300,000. Capital gains was $650,000. So in this case, we asked them, would you like? They're obviously wanting to sell that. Here's the problems: their taxes, the stress of management. So most folks that are selling their real estate is because they no longer want to be in the landlord business. So if there is a way that you can sell the real estate and pay no capital gains tax, avoid all income taxes and estate taxes, transfer the full value of a real estate to your heirs, and this is pretty cool, totally disinherit the IRS on the sale of the real estate. You can receive a tax deduction from the IRS. The IRS actually likes this as an opportunity. And again, we just asked, would you be interested in this? Well, let's take a look at this. So again, here's that $1 million. I'm going to just click through here. Estimated tax. Again, these are estimates. These are not guaranteed. But in this scenario is that $750,000 is what would be left over. If you multiply that by 5%, that's going to provide an income of about $39,000, almost $40,000 a year. That's the recapture tax. And again, if death would occur, you're leaving your heirs with $795,000. Now let's look at the opportunity of avoiding taxes. So we look at getting a tax-exempt trust for $1 million. And we get, when you open up that tax-exempt trust for that $1 million, you're actually getting a $300,000 tax deduction. And that tax deduction, again, when we're looking at this case, is you are providing, there's zero taxes involved. You're able to provide yourself or your beneficiaries with a $50,000 a year income stream. There's zero recapture taxes upon death. And upon death, you leave money to a nonprofit or foundation. This is a charitable remaining trust that we'd be working with. The other thing is we've saved that $300,000 tax deduction. So with that, there's a good chance that if you took $100,000 and invested into a life insurance policy, potentially a second to die policy. Again, this is just for illustrational purposes. We'd have to look specifically based off your ages, but that creates $1 million of a tax-free estate. So in this case, if you go back to it, it's really is, how do we give $1 million to your heirs? How do we provide $1 million of living, which is $50,000 a year for 20 years? And then we also leave money left over for a nonprofit. Again, that becomes income tax-free. Again, this is the current plan of the sale. This is just going to show you the numbers of what we're looking at. So again, with this opportunity is we are able to fund income for $50,000 a year versus $39,750. We're paying $0 in tax. We give $1 million your heirs through a tax opportunity. We're providing you income while you're alive or to your heirs. And then also we provided and funded $1 million to a foundation. Again, these are just for hypothetical purposes. We'd love the opportunity to be able to see if this works for you. And again, one of the CPAs that we work with says, you're better off if you give first than selling your asset later. So there's a lot of opportunities when it comes to how you give the money. And typically if we're giving prior to the sale, then those are opportunities you're going to need to look at with this. Again, here's the disclosure. That is a tax-exempt or referred to a 5227 trust called a charitable remaining uni trust, annuity trust, or a net income with makeup trust. So those are all opportunities. Again, real estate is illiquid. These are all just, again, review these slides. The minimum distribution required by law is 5%, but it actually could be a little higher there. But again, our goal for that 5% is to try to leave money to the nonprofits.